There's a situation unfolding in the silver market right now that most mainstream financial media refuses to discuss. And the reason they refuse to discuss it is not because it lacks importance. It is because the implications are uncomfortable. Let me give you a single data point, one number that should make every serious investor pause and pay attention. At this moment, the COMEX, the primary exchange where silver futures are traded, has approximately 47,000 open contracts for silver. Each contract represents 5,000 ounces. Do the multiplication, and you arrive at roughly 235 million ounces of silver committed on paper. Now here is the uncomfortable part. The registered silver inventory at the COMEX, the silver that is actually available for delivery against those contracts, sits at approximately 23 million ounces. That is a ratio of more than 10 to 1. 10 ounces committed on paper for every single ounce available to deliver. I want you to understand what this means. Not in the language of financial hysteria, not through the lens of conspiracy theories or apocalyptic predictions. I want you to understand it as a rational, composed investor who recognizes that markets, throughout history, have a peculiar habit of exposing fragile structures at the most inconvenient times. What happens when 10 people hold claim tickets to the same ounce of silver, and more than one of them decides they actually want the silver? This is the question we are going to explore together today. Not with breathless speculation, but with clear analysis, historical context, and practical guidance for how you might position yourself, regardless of whether you already hold silver or are simply watching from the sidelines. Let us begin. Before we can evaluate whether the current situation represents genuine systemic risk, we need to understand how the COMEX actually functions, because the relationship between paper contracts and physical metal is more nuanced than the simple ratio might suggest. The COMEX is a futures exchange. It exists primarily to serve two functions. First, it provides price discovery, a mechanism through which buyers and sellers establish what they believe silver is worth at various points in the future. Second, it offers hedging opportunities for commercial users of silver, allowing mining companies, industrial manufacturers, and other businesses to manage their exposure to price fluctuations. The vast majority of COMEX contracts are never intended for physical delivery. They are settled in cash. A trader who buys a silver futures contract is typically making a bet on price direction, not expressing a desire to take possession of 5,000 ounces of physical metal. When the contract approaches expiration, most traders simply roll their position forward to the next contract month or close out their trade entirely. This is why, historically, the ratio of paper commitments to physical inventory has not caused immediate problems. If 98% of contract holders never intend to take delivery, then the 2% who do can be satisfied with the available inventory. The system functions on expectations, on precedent, on the assumption that tomorrow will resemble yesterday. But here is where the analysis becomes more interesting. The COMEX distinguishes between two categories of silver in its vaults, registered and eligible. Registered silver is metal that has been explicitly designated for delivery against futures contracts. It sits in approved warehouses with proper documentation and is immediately available to satisfy delivery demands. Eligible silver, by contrast, is metal that meets COMEX specifications but has not been registered for delivery. It belongs to various owners who are simply using COMEX vaults for storage. When we cite the 23 million ounce figure, we are referring specifically to registered inventory. There is additional eligible silver, perhaps 80 to 90 million ounces, but that metal is not necessarily available. It belongs to investors, institutions, and entities who have their own plans for it. Assuming eligible inventory will automatically convert to registered inventory when needed is like assuming your neighbor will lend you their car simply because it happens to be parked next to yours. What matters is registered inventory, and registered inventory has been declining. Let me put this in perspective. In 2021, registered silver at the COMEX exceeded 150 million ounces. Today, we are looking at roughly 23 million. That represents a decline of more than 80% in just a few years. Where did it go? Some was withdrawn for industrial use. Some was transferred to investor accounts as eligible inventory. Some left the COMEX system entirely. The precise destination matters less than the trend itself. The metal available for immediate delivery against futures contracts has collapsed, while the number of contracts outstanding has remained substantial. This creates a situation that game theorists would find fascinating and risk managers would find concerning. Let us walk through the mathematics more carefully, because understanding the arithmetic is essential to understanding the risk. 47,000 open contracts multiplied by 5,000 ounces per contract equals 235 million ounces of paper silver. Against this, we have approximately 23 million ounces of registered physical silver. The ratio is roughly 10 to 1. Now, in normal market conditions, this ratio is manageable. Most contracts settle in cash. Most traders never intend to take delivery. The COMEX has operated with significant ratios for decades without triggering a delivery crisis. But the system's stability depends entirely on a specific behavioral assumption: that the historical pattern of cash settlement will continue indefinitely, that delivery demands will remain in the low single digits as a percentage of open interest. What happens if that assumption changes? Imagine a scenario where 5% of contract holders decide they want physical delivery. That would represent approximately 11.7 million ounces of demand. The registered inventory could theoretically handle this, though it would require delivering more than half of available metal. But what if 10% demand delivery? Now you need 23.5 million ounces. You've just exhausted your entire registered inventory, and you still have 90% of contract holders who took the cash settlement. What if 15% demand delivery? 20%? You begin to see the problem. The system functions beautifully at 2%. It becomes stressed at 5%. It breaks at 10%. And here's the critical insight. In markets, behavior is contagious. If word spreads that COMEX inventory is depleting, that delivery demands are rising, that the metal is running out, more participants will want delivery rather than cash. Not because they suddenly need the silver, but because they recognize the scarcity dynamic. They understand that being 10th in line for a shrinking inventory is worse than being first. This is the mechanism of a bank run. It is not about reality. It is about the perception of reality and the rational response to that perception. When depositors believe a bank might fail, the rational individual response is to withdraw funds immediately. Even if the bank is solvent, enough rational individual responses create the collective outcome everyone feared. The prophecy fulfills itself. The COMEX silver market has structural similarities. If enough participants believe physical metal is becoming scarce, and if they act on that belief by demanding delivery, the scarcity becomes real regardless of whether it was real to begin with. This is not speculation. This is game theory. This is how coordination problems manifest in financial markets. To evaluate the current situation properly, we should examine historical precedents. Has the silver market faced similar pressures before? What happened? And what can those episodes teach us about today? The most dramatic example occurred in 1979 and 1980, when the Hunt brothers attempted to corner the silver market. Nelson and William Hunt, heirs to a Texas oil fortune, accumulated massive positions in silver futures and physical metal. At their peak, they controlled an estimated 100 million ounces, roughly 1/3 of the world's deliverable silver supply. The price responded accordingly. Silver rose from approximately $6 per ounce in early 1979 to nearly $50 per ounce in January 1980, an eightfold increase in roughly 12 months. But the Hunt episode is not simply a story of price appreciation. It is a story of how exchanges respond when their structural integrity is threatened. As silver prices surged and delivery demands intensified, the COMEX changed the rules. They implemented position limits specifically targeting the Hunts. They increased margin requirements dramatically, in some cases overnight. They eventually moved to liquidation-only trading, meaning participants could close existing positions but could not open new ones. The Hunts were ultimately crushed. They faced margin calls they could not meet. They were forced into bankruptcy. The silver price collapsed from $50 back to $10 within months. The lesson here is complex. On one hand, the silver market did experience a genuine squeeze. Prices rose dramatically. Those who held physical metal during the ascent captured extraordinary gains. On the other hand, the exchange demonstrated it would not allow a true delivery failure. They would change the rules, adjust the playing field, and use regulatory authority to prevent the system from breaking. Which brings us to a crucial question for today's situation. Would the same interventions work now? The 1980 squeeze was orchestrated by two identifiable individuals with concentrated positions. The current inventory decline appears to be driven by diffuse demand. Thousands of smaller participants, industrial users, investors around the world. You cannot implement position limits against distributed demand. You cannot target specific actors when the entire market is gradually demanding more metal. There is another relevant historical example worth considering: the 2020 and 2021 silver squeeze movement. In early 2021, retail investors, inspired by the GameStop phenomenon, coordinated through social media to buy silver. The theory was simple. If enough people purchased physical silver and silver-backed ETFs, they could drain COMEX inventory and force a price revaluation. The squeeze partially succeeded and partially failed. Physical silver became temporarily scarce at the retail level. Premiums above spot price reached historic highs. Some dealers reported weeks-long wait times for delivery. But the spot price did not sustain gains. After an initial surge above $30, silver retreated. The COMEX did not experience a delivery crisis. Inventory remained sufficient. Why? Several factors. First, much of the retail demand was satisfied by existing dealer inventory and primary market supply, not COMEX withdrawals. Second, the coordination was temporary. Retail enthusiasm faded after weeks, not months. Third, mining supply continued flowing into the market. But here is what changed between then and now. After the 2021 squeeze attempt, COMEX registered inventory did not recover, it continued declining. The squeeze did not break the system, but it may have initiated a process that is still unfolding. When we look at the inventory chart from 2021 to today, we see not a spike in recovery, but a sustained downtrend. The metal continues leaving, and no one seems to be replacing it. Understanding supply is only half the analysis. We must also examine demand, and the demand picture for silver has evolved dramatically over the past decade. Silver is both a monetary metal and an industrial metal. This dual nature is crucial to understanding its market dynamics. On the industrial side, silver demand has been transformed by technological advancement. Solar panels require silver. Electric vehicles require silver. Electronic devices, medical equipment, water purification systems, 5G infrastructure all require silver. The Silver Institute estimates that industrial demand now consumes more than 50% of annual silver production, with that percentage growing each year. Solar panel manufacturing alone consumed over 140 million ounces in recent years, and projections suggest this could double within the decade as renewable energy deployment accelerates. This is not speculative demand. This is structural baseline demand from industries that cannot easily substitute away from silver. Copper can replace silver in some applications, but in many cases, silver's unique properties, its electrical conductivity, thermal conductivity, and reflectivity, make it irreplaceable at any reasonable cost. Now consider the investment demand side. Central banks around the world have been accumulating gold at the highest pace in decades. While silver does not feature prominently in official reserves, the signal from gold accumulation affects silver sentiment. When monetary authorities demonstrate distrust in paper currencies through gold purchases, private investors often extend that logic to silver. Meanwhile, concerns about currency stability, inflation, and government debt levels have been growing across developed economies. The United States national debt exceeds $34 trillion. Interest payments alone now consume a significant portion of federal revenue. Regardless of your political perspective, these fiscal dynamics create uncertainty, and uncertainty drives demand for tangible assets. Silver stands at the intersection of industrial necessity and monetary anxiety. It is needed by factories and wanted by investors. When both demand drivers align, as they increasingly appear to be, the supply situation becomes more consequential, and about that supply. Global silver mine production has been essentially flat for nearly a decade. Some analysts argue it has peaked. Major discoveries of new deposits have become rare. Ore grades at existing mines are declining, meaning more rock must be processed to extract the same amount of silver. And here is a critical detail. Approximately 70% of silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. This means silver supply cannot easily respond to price signals. If silver prices rise, you cannot simply open new silver mines. Most silver comes from operations primarily focused on other metals. Supply is relatively inelastic, flat supply. Growing industrial demand, growing investment demand, declining visible inventories. The arithmetic is directional, even if the timing is uncertain. We have established the structural context. Registered inventory is low. The ratio of paper commitments to physical metal is elevated. Supply is constrained. Demand is growing. But structure alone does not create crisis. Something must trigger the behavioral shift that transforms latent vulnerability into acute stress. What might those triggers be? The first possibility is a delivery failure or near failure. If the COMEX experiences a situation where registered inventory is genuinely insufficient to meet delivery demands, even temporarily, the psychological impact would be substantial. Participants who previously assumed cash settlement was equivalent to physical settlement would suddenly face evidence that the two are different. Trust in the paper market would erode. The second possibility is a significant premium divergence. If physical silver begins trading at a sustained premium to the futures price, say 10 or 15% above spot, the arbitrage opportunity becomes visible and compelling. More participants would buy paper contracts specifically to demand delivery, capture the premium, and sell physical metal at the higher price. This would accelerate inventory withdrawal. The third possibility is a geopolitical supply disruption. Silver mining is geographically concentrated. Mexico produces the most silver globally, followed by Peru, China, and Australia. Political instability, resource nationalism, or trade restrictions affecting major producers could constrain supply suddenly. The fourth possibility is an industrial panic. If manufacturers who depend on silver for production, solar panel companies, electronics manufacturers, automotive suppliers, perceive future supply scarcity, they may begin stockpiling. Industrial hoarding of critical materials is not unprecedented. We saw similar dynamics with semiconductors, rare earths, and other inputs in recent years. The fifth possibility is a monetary crisis that drives sudden investment demand. If confidence in major currencies deteriorates rapidly, whether from inflation, financial system stress, or geopolitical conflict, the flight to tangible assets could overwhelm available supply. This happened with gold in 2020. It could happen with silver. None of these triggers is certain. None is imminent on any specific timeline. But recognizing the potential catalysts allows us to watch for early warning signs rather than being caught by surprise. Let us now transition from analysis to practical guidance. If you already own silver, whether physical metal, ETFs, or mining equities, how should you think about your position in light of the current COMEX dynamics? First, understand what you own and why you own it. Physical silver that you hold directly, coins, bars, rounds, is not subject to counterparty risk. No exchange rule change can affect your metal. No delivery failure can prevent you from accessing what is already in your possession. This is a fundamentally different asset than paper claims on silver. If you own silver ETFs, understand their structure. Some ETFs are backed by physical metal stored in vaults. Others track silver prices through derivatives or other mechanisms. The prospectus will clarify which you hold. In a scenario where paper and physical markets diverge, these distinctions matter. Second, resist the temptation to trade excessively. If your analysis suggests silver is undervalued and the supply-demand dynamics are favorable, the appropriate response is patience, not activity. Every trade incurs costs, commissions, spreads, and tax implications. Every trade also creates an opportunity for emotional decision-making. The value of a position in silver, if your thesis is correct, compounds through time, not through trading. The appropriate question is not, what should I do today? But rather, am I positioned appropriately for the scenario I consider most probable? Third, consider your concentration. No matter how compelling any single investment thesis appears, concentration creates fragility in your personal finances. If silver represents a disproportionate share of your portfolio, you are vulnerable to timing risk. Even if your fundamental analysis proves correct, the market can remain irrational longer than you can remain solvent. A reasonable silver allocation for most investors might range from 5 to 15% of investable assets, depending on individual circumstances, risk tolerance, and conviction. This provides meaningful exposure to potential upside while maintaining diversification and resilience. Fourth, define your decision framework in advance. Under what conditions would you add to your position? Under what conditions would you reduce it? What evidence would change your thesis? Answering these questions now, while you're calm and analytical, prevents impulsive decisions later when emotions run high. Perhaps your framework includes adding on price declines below certain levels, effectively dollar cost averaging into weakness. Perhaps it includes taking partial profits if silver reaches certain targets, not because you believe the thesis is exhausted, but because risk management requires capturing gains. Whatever your framework, write it down, commit to it, and follow it when the moment arrives. Fifth, maintain liquidity outside your silver position. Even the best investments can decline before they appreciate. Markets can remain irrational. Unexpected expenses can arise. If your only liquid assets are silver, you may be forced to sell at inopportune moments. Maintain sufficient cash or near-cash reserves to handle life's contingencies without touching your silver position. This provides the staying power that allows a long-term thesis to unfold. If you do not currently own silver but are considering establishing a position, how should you approach the opportunity? First, educate before you allocate. The analysis I have presented today is a starting point, not a conclusion. Before committing capital, understand the silver market more deeply. Read about the history of silver as money. Study the industrial applications and demand trends. Examine the mining industry and supply constraints. Review the mechanics of futures markets and ETFs. Informed investors make better decisions and maintain conviction through volatility. Uninformed investors panic at the first drawdown. Second, start gradually. Unless you have unusual expertise or conviction, resist the urge to establish a full position immediately. Instead, consider building your allocation over months through regular purchases. This approach, often called dollar cost averaging, reduces timing risk and removes the pressure of trying to identify the perfect entry point. If your target allocation is 10% of your portfolio in silver, perhaps allocate 2% initially and add 1% each month until you reach your target. This provides immediate exposure while averaging your entry price over time. Third, decide on your preferred form of exposure. Physical silver offers the benefit of direct ownership with no counterparty risk, but it carries costs, dealer premiums, storage considerations, and potentially reduced liquidity. If you purchase physical metal, establish a relationship with a reputable dealer and understand the premiums above spot price you are paying. Silver ETFs offer convenience and liquidity, but introduce counterparty risk and management fees. The largest physically backed silver ETFs are transparent about their holdings and have functioned reliably, but they operate within the broader financial system. Silver mining equities offer leverage to silver prices. They can rise faster when silver rises, but fall faster when silver declines. Mining stocks also carry company-specific risks, management quality, mine development, jurisdictional issues, and operational challenges. There is no universally correct choice. Many investors hold some combination of physical metal, ETFs, and mining stocks, recognizing that each offers different advantages. Fourth, understand that you may be early. The dynamics I have described today are structural and directional, but markets can ignore structural realities for extended periods. The COMEX has operated with elevated ratios before without experiencing crisis. Paper markets can persist longer than seems logical. If you establish a silver position and the price declines 20% over the next year, will your thesis change, or will your confidence increase? If you cannot answer that question clearly, you may not have conviction sufficient to hold through volatility. Being early often feels identical to being wrong until it doesn't. Prepare yourself psychologically for that experience. Fifth, never invest more than you can afford to lose. This is standard investment advice, but it bears repeating. No matter how compelling any thesis appears, uncertainty is inherent. Unexpected developments can invalidate the most rigorous analysis. Position sizes should reflect this reality. If a complete loss of your silver allocation would cause genuine financial hardship, your allocation is too large. Adjust accordingly. Let me now address directly the behavioral errors that could undermine your strategy, regardless of whether the underlying thesis proves correct. Mistake number 1, emotional trading. Markets are designed to exploit emotion. They generate maximum pain at maximum inconvenience. Silver could decline significantly before it appreciates, and that decline will feel terrible. Headlines will mock silver holders. Paper losses will accumulate. Friends and family may question your judgment. The appropriate response to volatility, assuming your thesis remains intact, is nothing. Or perhaps strategic addition, not panic selling, not capitulation, not abandoning a rational position because of emotional discomfort. Emotional trading is how retail investors consistently underperform the very assets they own. They buy excitement and sell fear, guaranteeing poor outcomes regardless of asset selection. Mistake number 2, over-leveraging. The temptation to amplify returns through leverage, margin accounts, options, futures, can be substantial, particularly when you have high conviction. But leverage is a double-edged sword with asymmetric consequences. If you buy silver with cash and it declines 50%, you have lost half your investment, but you still own the silver. You can wait indefinitely for recovery. If you buy silver on margin and it declines 50%, you may receive a margin call, be forced to sell at the worst possible moment, and lock in permanent losses. Leverage converts temporary drawdowns into permanent destruction. It introduces timing risk to positions that might otherwise benefit from patience. Avoid it unless you are a professional with sophisticated risk management capabilities. Mistake number 3, ignoring opportunity cost. Every dollar in silver is a dollar not invested elsewhere. If silver stagnates while other assets appreciate, you bear that opportunity cost even without experiencing nominal losses. This argues for moderation in allocation. Maintain exposure to silver if your thesis supports it, but maintain diversification as well. The goal is to be positioned for multiple scenarios, not to maximize returns in a single scenario at the expense of all others. Mistake number 4, conflating investment with identity. Some investors become so attached to their positions that owning silver becomes part of their self-concept. They become silver bugs rather than investors who happen to hold silver. This attachment creates bias. It makes objective evaluation of new information difficult. It transforms rational analysis into ideological commitment. Your job as an investor is to allocate capital effectively, not to advocate for any particular asset. If compelling evidence emerges that contradicts your silver thesis, you should be willing to change your view. If you find such flexibility difficult to imagine, you may be too attached. Mistake number 5, expecting specific timing. The analysis I have presented today suggests structural vulnerability in the COMEX silver market. It does not suggest this vulnerability will manifest on any specific date or within any specific time frame. Markets can remain irrational longer than you expect. The COMEX has adapted to stress before and could adapt again. Industrial demand could decline unexpectedly. New supply could emerge. Any number of developments could delay the resolution of current imbalances. If your financial well-being depends on silver appreciating within a specific window, your position is too aggressive. Structure your allocation to benefit from favorable developments without requiring them to occur on schedule. Mistake number 6, neglecting the fundamentals of personal finance. No investment in silver substitutes for the fundamentals of financial health. Spending less than you earn, maintaining an emergency fund, carrying appropriate insurance, minimizing high-interest debt, and saving consistently for retirement. If these fundamentals are not in place, address them before speculating on silver or any other asset. The best investment in your 20s, 30s, or 40s is often simply increasing your savings rate, regardless of where those savings are allocated. Mistake number 7, relying on any single source of analysis, including this one. The perspective I have offered today is my honest assessment of the situation, but I am fallible. My information could be incomplete. My reasoning could contain errors. The conclusions could be wrong. Seek multiple perspectives. Engage with analysts who disagree with the thesis presented here. Understand the counter-arguments. Stress test your convictions. If your position cannot survive scrutiny, it is not robust enough to hold. Let us return to where we began. 47,000 contracts, 23 million ounces, a ratio that raises legitimate questions about the structural integrity of paper silver markets. What should we make of this situation? I want to offer you a balanced perspective, one that neither dismisses the dynamics at play nor guarantees any particular outcome. The mathematics of the current COMEX inventory situation are unfavorable. The ratio of paper commitments to registered physical silver is elevated by historical standards. Inventory has declined dramatically over recent years and shows no sign of recovery. But mathematics alone does not determine market outcomes. Institutions adapt, rules can change, behavior is difficult to predict. What we can say with reasonable confidence is this: the silver market has structural characteristics that create fragility. It depends on behavioral assumptions that may not hold indefinitely, and it operates against a backdrop of growing demand, both industrial and investment, and constrained supply. This does not mean prices will rise tomorrow or next month. It means the conditions exist for significant repricing if and when behavioral patterns shift. As an investor, your responsibility is not to predict the timing of such shifts. Your responsibility is to ensure you are appropriately positioned if they occur. For those who already hold silver, this means maintaining conviction through volatility, managing position size prudently, and avoiding the behavioral errors that undermine long-term performance. For those considering silver, this means educating yourself thoroughly, building positions gradually, and maintaining perspective about what you own and why you own it. For everyone, this means remembering that investment success is not about being right in any single trade. It is about managing risk, maintaining discipline, and making decisions that compound favorably over decades. The COMEX situation will resolve itself one way or another. Either inventory will be replenished and the ratio will normalize, or delivery demands will increase and the system will face stress. Either outcome will become clear eventually, but it may take longer than any of us expect. What matters for you is not predicting which outcome occurs or when. What matters is ensuring you can participate in the potential upside while surviving any scenario that unfolds along the way. That requires patience, it requires discipline, it requires resisting both the euphoria of bull markets and the despair of corrections. I cannot tell you what silver will do tomorrow or next year. No one can, regardless of their claims. What I can tell you is that informed investors who maintain discipline, manage risk appropriately, and position themselves for multiple scenarios tend to outperform over time. Not because they predict the future correctly, but because they prepare for multiple futures and allow favorable developments to compound. The math may break the COMEX, or the COMEX may adapt as it has before. Either way, your job remains the same. Understand the dynamics, position appropriately, and let time do the work. Thank you for your attention. Stay rational, stay disciplined, and I will see you in the next analysis.